All right, I'm Michael Hartzman. Today is Tuesday, February 10th, 2026. And I'm on as always with my partner, Dominick Tavella, who became a lot smarter over the last few days and got out of Long Island and appears to be down in Florida. So good for you, Dom. Good evening. How are you?
Thanks, Mike. Managed to escape and a little bit better off, but I won't be bragging about it because you know iguanas will come falling out of trees. So, unfortunately, Florida got a little bit of a cold snap and wasn't too good of a scenario for the local wildlife. But I'm doing well, Mike. How about yourself?
I'm doing well. It was we didn't have any. I didn't find any iguanas on my lawn playing dead, but it was 2 degrees when I woke up Sunday morning. So there's that.
Well, I don't know if it makes you feel better, but I woke up to the same thing, but I managed to get back down here. So at least I'll be down here for the next couple of weeks, and this is where you're going to find me.
Well, I'm not gonna lie, it does make me feel a little better. So look, let's just jump right into it. We're basically halfway through the first quarter of the year. Hard to believe. So now, some of the numbers we talk about year to date, they're real numbers now. We've been at this for 6 weeks so far for 2026, and through Friday, through I guess February 7th, the Dow Jones was up 2.5% for the week and 4.35 for the year, which is pretty good. The S&P is up 1.3 for the year, and the Nasdaq's actually down a little less than 1%. I don't, you're not including what happened yesterday or today, but the Nasdaq, as typically, has been the story lately of the market. And let's start there, Dom. Last week, a lot of big tech household names reported reported fairly decent earnings, a fairly decent outlook, but it wasn't perfect, right? No one said everything is just perfect. And as a result of that, all these huge names, whether it was Apple or Amazon or Google, they got punished a little bit. And Microsoft, especially, they all got beat up a little bit because they didn't give investors exactly what they wanted to hear.
Yeah, so I think that's the headline right now, Mike. You brought up the Nasdaq being down a little bit less than 1%, but if you focus, and we've focused on this a lot, but if you focus on the Magnificent Seven, the Microsofts, right, the Nvidias, on the average, they're down 3.5% for the year. So you have an environment where the S&P is plus, call it 1.5. As you said, the Dow is plus, I think, north of 4%. We're going to talk about small cap, mid caps, international in a second. But you have the NASDAQ negative, and more important, all these super tech stocks you had to own. You had to own the Magnificent Seven. We've talked about market weighting and the effect it does on the overall markets. And for the most part, they are negative year to date. And I'm going to repeat, that's the headline right now. Still mid-February, but that I think is the big news of the day. How can all these companies that just have been market leaders for the last 3 years, how can they be negative on a year-to-date basis?
Well, look, I would say to you, that's kind of a good thing, right? Because and the last thing investors need is total complacency, where they think investments and stocks just go up and it's easy money. So a reality check every now and again is important. And this is not remotely what we went through last April when the tariffs were announced. But look, we've been doing this podcast now for close to 5 years, I think, and we've said it repeatedly. A little bit of a sell-off, a little bit of a reality check, a little bit of a smack to the back of the head is not necessarily a bad thing.
Yeah, Mike, just echoing what you just said. I saw a very significant analyst talk about what the market dynamics look like these days, and he actually said, if you would have told me on a year-to-date basis the Nasdaq would be negative and the Magnificent Seven as a group would be negative, I would have predicted this market would be a disaster. We'd have a significantly negative S&P. All the major indices would be down. So the fact that you can have these market leaders be negative for the year, but the major indices, in this case, the S&P 500, the Dow, we're going to talk about the other ones in a second. That's actually a very healthy, that's your point, Mike. It's a very healthy sign that, you know what, maybe we need to look at, and how many times have we said this, Mike? Maybe we need to look at the other 493 stocks.
or the other 1,993 stocks in the
Yeah,
Russell 2000.
we said Magnificent Seven, but we actually keep talking about the top 10, right?
Yeah.
So and again, all of them, whether it's an Amazon, a Microsoft, they've gotten in some cases beat up pretty good. Like this has not been subtle like a sledgehammer, right? So I think last time I looked, Microsoft was down 14% for the year. We won't even talk about Oracle; it's just fallen off a cliff. And all of this having to do with, is AI for real? Is all the money that these companies are spending at this point estimated at $660 billion invested in chips and data centers? Is it real money, and will anybody ever make a profit off of it? It's the big question mark right now in the markets.
Yeah, and I was going to make a joke and say, well, we could always go on ChatGPT and ask ChatGPT if AI is ever going to make any money. But I will tell you, speaking of that, a year ago, I never went on ChatGPT. I didn't even know where to start, right? And my son got me on it, and honestly, Dominic, I use it all the time. I ask it questions all the time. I don't live by it. I don't make medical decisions by it, but it is a useful tool. It is fun to use. But I think you pointed out this morning that you were listening to a sports talk show, and they asked ChatGPT a trivia question, I think you said, and they got the
Yeah.
answer wrong somehow.
Look, the tell. I mean, nobody's got a crystal ball that can predict the future, right? But I think on this one, we can get a picture of what the future looks like. And then, I saw an interview with a doctor who basically says, "Look, I'm not relying on this thing as a sole singular tool for making a medical diagnosis on my patient, but I don't mind feeding in, these are what the symptoms look like, this is what the results I'm getting, da da da. What are the probability of A, B, or C, right?" And you're using technology, artificial intelligence, to help you, assist you in coming up with a decision or a diagnosis. Is it foolproof? Is it 100%? No, we're still early in the process. But back to kind of where I started, to think that all of a sudden this stuff is not going to work, it's not going to be in our lives. I think, frankly, and jump in with I'm wrong, Mike, but I think the markets right now are kind of the pendulum swinging in the
Yeah,
wrong direction for a little while.
I know. I agree with you. I know you're not wrong. Look, you do a lot of television hits. They require a lot of research. I remember years ago, you would tell me you would do 2 hours of research for 3 minutes of television, and then there's headline news or a bulletin, and you get canceled, and you're not getting that 2 hours back. I write articles frequently for a couple of newspapers on Long Island and around the nation, and I got to do the research. And I just did an article in January, a recap, and quite frankly, Dominic, the data I needed, I got in less than a minute. I didn't ask them to write the article. I just asked them to do the background that would have taken me 30 to 45 minutes to accumulate.
So, and we're just touching on some of the uses. Some of the uses we can't even fantasize about right now because we just don't know enough to know. Having said that, the idea that these companies are doing this and all this money is just going to waste, I think is a stretch, Mike. Again, who the winners are, who the losers are, whose technology is going to work better. That's all to be determined yet, right? But the idea that artificial intelligence and its usage in our economy is not going to be there and powerful, I think is silly. I really, honest to God, think it's silly, mate.
I said it this morning. It reminds me of what happened 30 years ago, Dominic. Right now, people think the internet is this magical pixie dust place where you just go on the internet and just it's magically there. It had to be built. It cost billions to build out the fiber networks and the equipment required and the technology and the phone routers. it just didn't magically appear. And to me, Dominic, that's what's happening again with this the infrastructure of AI. It's got to be built. There'll be winners and losers. Not everyone's going to make money. Not all companies are going to be successful. Everyone jokes around now. You still have an AOL email address, right? AOL was the thing when the internet first became as ubiquitous as it is now.
Mike, you brought up a really good point this morning, and I don't think you'll mind me sharing it with our listeners now. But I made a point about that an estimated $1 trillion in total was going to be needed to build out the AI infrastructure space. And your point was, well, how much did we spend to build out the internet, right?
Right.
And I don't know what that number is, Mike, but if you think about the decades and decades, and like you said, the routers and the changers and the computer software and the equipment, and all to make the internet work. And no one can argue today, this very podcast is based on our ability to use the internet. And you in New York and me in Florida. Um, how many billions of dollars did it take out to build out the internet? Nobody even questions it today, right? But back then, we didn't know. And so, what are these companies doing? Does it make any sense? Is there going to be any economic benefit? We didn't know the answer. We do know the answer today. We couldn't function without the internet.
Look, I remember, you and I have been independent financial advisors for a long time. And the access of information that we have now, back then, before the internet became so user friendly, would literally back then, if we bought the technology we use now and take for granted, all the stock information we get in the research, it literally would have cost us $5,000 a month that we get for free now.
Not all of it for free, Mike, but yes, there are quite a few services that we have to subscribe to. I'm being funny, but that's actually a valid point. So the companies that we're paying for these services, they're making money, right? They're utilizing the internet and technology to provide us a service that we are happy to pay for. And it's that our ability to pay for it, and not only ability, but wanting to. Hey, you're providing me a service. I couldn't function without that service. So therefore, I am willing to pay. And by definition, that is what's going on with artificial intelligence. They're
Right.
trying to build out this infrastructure. Right now, it's just a boondoggle. Nobody has any clue where it's going, what it's going to look like. But at some point, these companies are going to provide services that somehow magically, not only we can't live without, but we're willing to pay for it, Mike.
Exactly.
And
Exactly.
that's how all this is going to get paid for. We just don't know how, and we don't know when.
Yeah, and if anyone's wondering which one of the two of us has training as a CPA, it's clearly you. But what I meant by free was all the stock research that we get
Yeah,
and all the quote information we
again,
get.
joking a little bit, Mike, but
Yeah.
and I don't think I've brought this up, but there's one particular service that literally costs us an arm and a leg, and I would never divulge the numbers, but it literally costs us, and I don't think there's a number I hate writing out a check for every month more than that bill. But the flip side of it is we could not run the company. And so you go, all right, this really stinks. But guess what? I could not run an entire company, employees, clients, trading without these services, right? And
Right.
I think again, I'm going to come back to the end game, which I don't know if it's 5 years from now, 10 years from now, but there will be services, whether it's us in the financial services industry or doctors or lawyers or CPAs, they're going to pay for that service because it's going to be indispensable to how they run their business.
Yeah. And look, you could do it, but you'd probably have to hire 10 employees to do it.
So just changing gears slightly, Mike, one of the sectors in the AI space that has just gotten wrecked. We talked about the Magnificent Seven, but how about the software companies? You want to spend a minute on that, Mike?
Yeah, absolutely. So they call it software as a service, and I think that's why Microsoft got clobbered,
One of
right?
the major reasons why Microsoft got clobbered.
Yeah, because the threat is that AI could do what these software programs do that we pay for, they could do it in a fraction of the time and more
And,
efficiently.
and I don't think this is a big tell, but we both use Microsoft software in our offices.
Yeah.
Mike, are you really going to terminate your relationship with Microsoft so you can hire a AI bot to run our computers in our offices? Would you? Are you really going to do that, Mike?
I'm not going to do that, but our kids might do that in 25 years.
Yeah, so I'll let them worry about it in 25 years. But,
Exactly.
and again, I don't have a crystal ball here, Mike, but I think this idea, and I think of like a service now, one of these CRM software,
Hmm.
business operating systems. I understand that maybe somewhere, someday, somebody can build an alternate world that could take these companies places, but it ain't going to happen today, and it's not going to happen tomorrow. Would you
Exactly.
agree?
Exactly. No, I agree. Obviously, I agree.
And
So
before
look,
you
I just,
jeopardize your entire company by getting rid of one of these mainstream, established, documented, bulletproof services, we'll pick on Microsoft or ServiceNow. Before you get rid of them to use an alternate AI technology, I would think that you're going to give it a lot of thought.
oh yeah,
I
absolutely.
don't think
Look,
one of us who's got a real business to run with real client money, we're going to jeopardize our livelihood and our business and our company reputation. So I want to vote that I think the technology software side is way overblown, at least in the short term.
it isn't a short term, but it's going to happen, Dominic. I remember when we converted my office to go paperless, and we were going to scan everything and rip all the paper up. And I remember thinking, God, that's a terrible idea. But we did it, and it's fantastic. I remember when we got a check scanner, and we upload the checks now to Raymond James, and then they take the check and they rip it in half. Right? That was unimaginable to me 15, 20 years ago, Dominic.
Well, and you know, we're kind of trying to make sure as best as we can that the listeners kind of understand where we're coming from. And the example I use all the time is we used to have to get forms signed by a client, right?
Right,
So we would draft all these documents, put little stickies, sign here. We'd stick them in a FedEx envelope. We overnight it to the client. The client signs it. They sent overnight it back, and then we would take those documents and mail them to the clearing firm, right?
right.
Now all that is done electronically,
And takes a fraction of the time and a fraction of the cost.
and we're not paying for all these ancillary services,
Right. So
right?
so so I agree. Software as a service is not going away tomorrow, but the landscape is changing, is my point. Right. But
So
not tomorrow
yeah,
or the day
change is
after.
coming, but not in a day.
Right. So
Not in a
just to switch gears for a second, a couple of weeks ago on our podcast, the two of us, I don't want to speak for you. I certainly was hyperventilating a little bit about all the headline risk, and some of the absurdity of the headline risk of trying to go to Federal Reserve chairman in jail and somehow be a buying or invading Greenland. It seemed absurd, and I was overly, as it turns out, probably a little overly concerned about it. So now, Dom, I don't know if you noticed, we had last week the opposite of headline risk. We actually had a shutdown last week of the government, and the Dow, by the way, went over 50,000 points. Now, those two stories didn't get any attention last week somehow. So, how do you explain that?
well, I want to step back to the first point you were trying to make. And yeah, we talked a lot about this is the definition of headline risk, right? Whether it was Greenland, we're going to invade it, whether we're going to put the chairman of Federal Reserve in jail. I mean, just and the market did react, right? We got a little bit of a pullback in the major indices. But I think, and this is to your last point, I think the markets, people are just getting a little numb to it, you know?
Mm-hmm.
It's like, oh, there's a tweet at 3 o'clock in the morning. Oh, there's another headline. And how serious is that headline? How significant is it? And how much economic impact does it have? I think people are starting to just go, yeah, yeah, yeah. We kind of know how this story goes and how the story will end. So, to the last part of your point, Mike, the markets have become a little numb. Some of these headlines.
Mm-hmm. No, I
Uh,
know. I
and
know. And
maybe that's a
again, I,
good
I don't
thing,
I
you
don't
know.
know.
We can't keep reacting to every headline that comes across, or tweet that comes across, at 3 o'clock in the morning. We can't keep doing that.
No, I agree. Um, but I did think I agree, but I do think it was interesting that, and I think it was a partial government shutdown. So I don't even know what parts of the government were shut down, but I remember seeing the headline, "The shutdown's over," and thinking, "We had a shutdown."
Mike, I don't remember when the first time the announcement of a government shutdown. Maybe you're better at this than I am, but I remember the market was down like 5-10%,
Yeah,
and now
yeah,
nobody cares. Good, they're shut down. Yeah, at least we don't have to hear any noise anymore. Let them all play some game in the schoolyard, and we'll just keep doing our job every day. So I think we're all figuring out that a government shutdown, other than the poor workers, and I don't want to minimize this at all. There's a lot
right.
of federal workers that eventually got paid, right? Eventually got paid, but maybe they didn't get paid on a Friday, so they couldn't pay their mortgage, they couldn't pay their car bill. And that's the real sin in this, that innocent, hardworking people are the ones that sacrifice, right?
Right.
But at
No,
the end of the day, did it really change anything? And the answer is no,
no, no.
right?
I switching gears again. Um, I know this has been a subject you watch very, very closely. Let's talk about the international markets for a little bit. Through last Friday again, February 7th, the EFA European Index was up 5.76%, and the emerging market index, geez, was up 7.34 over a 1 year period. The EFA is up 31.5, and EM emerging markets up 40.5. Now, again, you talk about some stealthy moves. Those are big moves.
Yeah, and Mike, I always like a little humor, but we've talked about this. You and I used to sit in these conferences, and they would talk about international, and then another year would go by with basically no performance, right? And last year there was really significant performance, and that is going on into this year. And so, and I do want to bring up, and I guess we'll cover one of these at a time, but last year's uh, uh, the large cap growth space, these tech stocks did really well. International did really well too, but small cap and medium sized companies, mid caps did not do all that great. This year it's the exact opposite. We have international leading the space, emerging markets, small cap, mid cap stocks are roaring. So kind of everything that didn't work so great last year is working really, really well this year, with the exception of international that worked really well last year and is continuing this year. So
But
yeah,
what do you,
international is a good large exposure in all our client portfolios. It's performing really, really well. And there's a lot of reasons for it, but the biggest reason is we're seeing the dollar depreciate against other currencies. And that means that if you're holding something in Germany, in euros, or in France, or in Italy, or you're holding other currencies, South America, Indonesia, those currencies have appreciated in value and the US dollar has depreciated. So, by definition, the value of those stocks has gone higher. Throw in that the global growth story is real. We're seeing a lot of economic activity and growth around the world, and you're having one of the best performing sectors internationally that we've seen in a long time.
so do you attribute the decline in the dollar because of what the comment you just made about world growth expanding, or do you attribute it to the I don't know how I want to say this politely, the uncertainty of where America stands on a world stage as a trading partner, or do you think it's a combination of the two
Yeah, I'm
or
going to go
something
with
else?
with three on your list, Mike. So there are companies that do this kind of, and we look at their research, but there's two components to why international markets did so well last year: the depreciation of the dollar and then economic activity and global growth. So even if you were to take out of that equation the dollar going down in value, there was still the international markets would be up, not as much, but they still would up. So hypothetically, if the international markets were up 25%, maybe 10% of that was the dollar, 15% is economic growth. And again, we are seeing some really good economic growth around the world. I want to go almost as byproduct of the Trump policies that all of a sudden these countries have to start talking to each other and trading with each other to stimulate their own economic activity because obviously there are tariffs here in the United States. So all of a sudden you have Europe talking to India and Europe talking to China and Europe talking to South America and all those crisscrossing each other trying to build up economic activity because of the situation here in this country. So the good news is these countries are finding resources and it's stimulating their own economies. And as an investor, we definitely want and have quite a few of our eggs in that basket.
So to that point, you and I met with some economists in the last 2, 3 weeks from New York Life, Mackay Shields, and from BlackRock. And I asked the gentleman from BlackRock if he felt if the decline in the dollar was a systematic decline as retribution to the tariffs a year ago. And he said no. He felt that the dollar decline, there's more to it than that. That's kind of an oversimplification of what happened to the dollar. But I'll ask you, do you think the decline of the dollar was kind of a systematic way to basically say to America, we're not going to take these tariffs and all these threats lying down? Or do you think there was something more complicated to this story?
I'm going to vote for the latter, Mike, because look, if these and we've talked about central banks around the world and how they're selling U.S. dollars and buying gold with it, right? Um, so some of it, I think, is just I wouldn't say it's intentional to crash the dollar. It's not in their own self-interest to do that.
Mm-hmm.
So, from a selfish perspective, they would not want to do that from their side of the trade,
Mm-hmm.
right? Having said that, if you're going, hey, I have a situation where I'm not entirely comfortable that my partners on the other side of the trade are going to be 100% there 100% of the time, maybe I should take some of my investable assets and put them somewhere else. And I think that's the answer, Mike, where they're going, hey, I need to be prudent, just like we allocate our portfolios, right? Hey, maybe I need to take some of my investable assets and move them somewhere else. So some of that capital, instead of coming into the United States, is going into Africa. It's going into South America. It's going into Southeast Asia. They're looking for opportunities to make their currency, their assets work. And if they're not 100% certain they're going to be treated well here in the United States, they're going to look for other opportunities. And maybe they had gotten a little lazy in the past and things were good. Why rock the boat? But nowadays, these countries are going, maybe we need to rock the boat, right? We need to look at diversifying our own economic activities so as to protect ourselves, just in case America does go in a completely different direction. I think that's fair, right, Mike?
Yeah, I do. I know, and I agree with you, right? And I do kind of think it's an oversimplification, but it's not a coincidence that the dollar basically tumbled, within a week of those tariffs being, threatened.
I don't think I think that's a pure market reaction, and I've sat in those meetings with you, Mike, and they'll go, no, no, it wasn't intentional. And you're going, well, I don't know, but if I'm putting it in an again, I'm going to come back to how we run our portfolios, right, Mike? If we have certain client assets sitting in a certain sector, and we don't think we're being treated well, what do, Mike? What
We
do we do?
say goodbye.
Goodbye, right? We have a responsibility to our clients to put our eggs in a basket that we think we may be wrong, but at least we go into it thinking we're going to get a positive outcome. So if we even sniff that the outcome may not be positive, it's goodbye.
Yeah,
Right, I'm out of here. I'm going to go
yeah,
put my eggs someplace else. So I'm not defending anybody. I'm not accusing anybody. I'm saying is it's common sense and logical that, hey, I'm going to take my eggs and kind of spread them out a little bit
yeah.
more and just do it, if nothing else, to be prudent and careful with our assets.
So on that note, let's take a quick break. You catch your breath, get a drink of water, and we come back to let's talk about gold and silver and some of the other rare earth minerals, and let's talk about also a little bit when we come back what's happening with small and large cap and whatever else pops into our heads. So we'll be
Great.
right back. All right, I'm Michael Hartzman, back with my partner Dominick Tavella. Had a good conversation the first half. Let's switch gears a little bit and let's start with gold. Gold last year, I was just looking on the break. A year ago, Dominic, gold was less than $3,000. Last February 11th, it was $2,932. Sometime in sometime in the fall of last year, it made all kinds of headlines. It went to $4,000. Went from 3,000 to 4,000, in less than a year. And now, in the blink of an eye, it's $5,000. $5,000. I know you have a long history and relationship with gold. You're from a family of jewelers. Um, this is a crazy move by any measure. Um, I have a few reasons why. I'm sure you have a few reasons why. I'll let you go first.
Thanks, Mike.
You're welcome.
But I'll be hitting that tennis ball right back in your court in a minute. So look, a year ago we were hearing how China in particular was starting to accumulate gold, and then India as well, particularly because the tariffs and trading relationship with the United States was starting to accumulate gold. What we didn't know back then, and we do now, is a considerable number of central banks around the world were selling dollars, selling US government bonds, and using that cash to buy gold. So, a stat that I still find absolutely mind boggling is that central banks around the world today hold more gold than US dollars, US securities. They clearly have shifted what they want to call as their reserves, and they still hold quite a bit of dollars, quite a bit of US securities, treasury bills, but now they actually own more gold than they do US dollars, US securities. It's just, there's no way gold could go up as much as it has in what is a relatively short period of time, unless we're talking about very, very big players on the global stage were buying it, and now we know who is buying it, Mike. So
Yeah,
I'm going to toss the ball back to your court and let you add your 2 cents, but it's a move that no one predicted.
exactly. And I do agree with you. And also what our clients and investors and listeners have to bear in mind, in theory, Dominic, there's an unlimited supply of dollars. We could print more. There's a finite amount of gold, right? So
Very. People don't even understand because I mean we all have it in our lives, right? It's jewelry or whatever, but there really is a very limited amount of gold
right, and
in
it's
the world.
expensive to get to it when you find it, right? So I do think that's part of it, and I also think because if I look at that chart again, in real time, the run up of gold basically coincides almost perfectly, Dom, where when the Liberation Day and the tariffs were started on April 7th, gold was $2,973, and by May 7th, it was already up almost $400, right? And then it was stable, and then it started to climb in the summertime. So I do agree with you that a lot of these large nations were using gold, as a store of currency, for their own protection and also as a little bit of defense. And also, gold, Dominic, in a time of unrest and geopolitical uncertainty, people want to accumulate gold for some reason as well, right?
Yeah, Mike, traditionally, you looked at either fear, and that's some kind of global event, or inflation, right? If you had super high inflation, people would want to own the metals, particularly gold, because that gave you a hedge against inflation. Ironically, yeah, we've had certainly geopolitical events, but nothing massive, or nothing that extended out for a really long period of time, other than the war with Russia and Ukraine. So geopolitically, that didn't move the needle. Inflation, even though it's higher than we want it to be, is still way lower than it used to be. Um, So what's going on? Countries going, you know what? We need to have something that is independent, valued independently, and obviously is a commodity that can be traded. And is being scooped up around the world.
Yeah. And look, we both took economics 101, right? So there's a finite amount of gold and people want it. It just is supply and demand. It's just that simple.
So, Mike, I'm going to ask you back the loaded question because we're both pretty staunch supporters of what's going on in gold and why. But why silver? What is going on there?
Well, you threw me a softball, not a fastball. Thank you. Thank you for that. You're a good man. So what I understand, Dominic, is going back to the conversation we had in the first segment about AI and what's going on there and quantum computing and supercomputers and these computers becoming faster and faster. They require a tremendous amount of metals, not just silver, whether it's copper or zinc or uranium. Uranium, if people talking about nuclear, if you're going to start using nuclear energy, you need uranium. So yes, silver gets the other big headline because it's also had an enormous move. But rare earth metals in general, Dominic, have really had an amazing 12-month run as a tailwind to the AI buildup.
I agree, Mike. But I will argue that central banks around the world, not because they don't want to, it's just not practical. Central banks around the world are not collecting silver.
They're not. They're not.
You would need the Empire State Building filled to make a dent in your net worth, right? So I think there is a speculative nature to silver, and obviously there are people speculating in gold, but I think there's a speculative nature to silver that is not necessarily or as much as there is in gold. And we saw silver drop by what, 35% in one day. Was it a week or two ago, Mike?
Yeah, I'm pulling it up right now.
So for
Yeah,
people that want to trade silver, just be a little bit more careful, right? There really is an economic, as Mike said, economic 101, why supply and demand, why gold makes sense, at least in the past. We'll see about the future, but the economics aren't quite the same revolving around silver.
yeah. No, you're right. But the economics not the same in terms of speculation and using it as a store of value. But part of the run up, as I said, is because there's a demand to use it for stuff to get these
And
supercomputers.
listen, you know everything that I shouldn't say everything, but a lot of what Trump is doing is to again, style aside, I don't want to get into that kind of commentary, but substance, he's trying to solidify our potential to have and control and acquire in the future rare earths.
Yeah.
It's really important to our future.
No,
So
it
there is a
is, and
method to the
we've
madness.
we've talked about it in other shows. I mentioned nuclear energy, and Lord knows what I know about it could fill a thimble, but I do know you need uranium to do the fusion. Am I correct?
Yeah, yeah. Again, I'm with you on that thimble example, but we definitely need uranium and we need rare earths to continue the technological revolution that this country will go through over the next 10 to 20 years. No doubt
And
about it.
and just to put a bow on your point about silver and the speculation of it, a year ago it was $32 a bar, I guess, or an ounce, and on January 27th, which you're old enough to remember, it was 13 days ago, it was $115. So if you were the unlucky soul who bought silver that day, you're down $25 on that investment in 10 days.
Yeah, and that's what we mean about the speculative nature of it versus gold, because gold might be down, I don't know, a couple of percent, right? Like
Mm-hmm.
couple, two, three, maybe.
Mm-hmm.
But silver at one point had, I think it's rebounded a little bit, but it was some 35% off the high when we got that bounce. Now, again, it's rebounded as well. What we're saying to investors, just be careful on that one, right? It's not quite the same economics that gold is.
So I mentioned I mentioned earlier, Dominic, that you and I met with some pretty smart economists a couple of weeks ago. And we the first question one of us inevitably always asks is what their prediction is for the economy and how they think the economy is going to grow. And and the numbers range from 2.5 to maybe 5% this year in GDP, which are blowout numbers, right? They're phenomenal numbers. And then the flip side of it is we are going to get a new Federal Reserve person to take over for Jerome Powell. Jerome Powell's term is up. And, I know you believe that the Fed is supposed to be in it. The new Fed person, if he's appointed, has already said he believes with Trump that interest rates should be lower. So, Dom, how do you square that round peg? If we get between 4 or 5% growth, how does any new Fed chair lower interest rates? What am I missing? What has to be in place to justify a lower interest rate environment where rates aren't awfully high at the moment in the midst of that type of economic
Well,
prosperity?
that's you throwing me a softball, Mike. So when we look at the Federal Reserve, they have two mandates. Inflation, they need to keep it within, I'm going to call it 2% range.
Mm-hmm. Mm-hmm.
And the other one is unemployment. They do not want unemployment to get excessively high. So for the most part, these last 4 to 6 years, the Fed has predominantly almost solely completely worrying about inflation. Inflation, as we all know, it hit exceedingly high numbers during the last administration. I think we were up north of 9%. And that inflation number has been coming down, not where everybody wants it, not where the Fed wants it. But all of a sudden, the focus of the Fed has shifted away from inflation and they're looking at the employment numbers. And what we know, Mike, and we have a great guest, and you're welcome to bring him up, and I'd love to see him the next quarter. He tells us, and he told us a long time ago, and now we're seeing the data that proves it. We are in a no hire, no fire economic environment.
Mm-hmm.
There is virtually no job growth going on right now. So whether it's businesses going, I don't feel comfortable enough to hire somebody, whether it's, hey, expenses are too high and I'm going to try to do more with less. There's a multitude of reasons, but college graduates are having a really, really difficult time of finding a job. And the unemployment rate has ticked up slightly. Again, we're in this no hire, no fire environment. But I think the Federal Reserve is really worried about what happens if the dam breaks and businesses start laying people off. So they're trying to prevent that from happening. They're trying to be proactive. And that's why this discussion about we need to cut interest rates. Like, well, the economy's doing so great. Why would we need to cut interest rates? They're trying to prevent the dam from breaking, Mike. They're trying to get the unemployment number lower if possible, but certainly not go any higher.
Yeah, and look, and as good as the economy is, we've said it for a long time. There are cracks in the economy, and the job market has been deteriorating slightly for kind of an extended period of time now.
Look, and I have to use the word wonky at least one time during these
It's
podcasts, but
obligatory.
we did get a retail sales number this morning, and it wasn't supposed to be spectacular, but it was supposed to be positive, and it was zero, right?
Yeah.
There was no growth in retail spending. Now, we can explain that a number of ways. We can talk about, hey, people spent all their money during the holidays, and then now they're just about paying down there's a lot of reasons why that could have happened, but it's kind of unusual. Wouldn't you agree, Mike, where consumers don't spend money, right? It's a little unusual, especially for the American consumer. So again, cracks in the armor, cracks in the environment. We're starting to see little tells that going, maybe things aren't quite so great. But the economy is on a good, strong, healthy path, and we don't want it. We don't want it to fall off the cliff.
Right, absolutely. Don, with the last few minutes we have of the show tonight, I want to, I guess we'll call it a public service announcement. New York State enacted a law, again, that went very quietly into effect on January 1st, that affects small business owners. And by small business owners, Dominic, I mean 10 employees or more. So effective January 1st, if you own a business that it has 10 or more employees and you've been operating for more than 2 years, you have to put a 401k plan in place for your company if you don't have one now. What do you think of that?
Well, let me start so we're clear. This is a New York State
Yes.
law.
Yeah, New
So
York State.
obviously not California, not New Jersey, right? But it puts a very substantial burden on small businesses. Now, we install 401k plans, we manage 401k plans, we live and breathe this stuff, but the average plumber or carpenter or retail store, that's not their business, right? That's not their business. So they're going to have a lot of catching up to do. And I imagine it's going to be after March 15th because that's corporate filing dates, and the accountants are going to go, "Oh my God, you got to do this, you got to do it." So I imagine our phone is going to be ringing off the hook, and I think it's an added burden that I don't know if small businesses want more on their plate than they already have. Again, state of New York mandated.
And if you think about Dom, I mean, you and I both know store owners, right? Yeah, you have a cousin who owns a pizza shop, right? I mean, none of those. I'm not saying your cousin doesn't, but most small store owners do not put in retirement plans, whether it's a salon or a clothing store. In my experience, it's been rare. And if you own a retail store, you could easily have 10 or more employees working there.
Yeah, look, and I want to go again. This is self-serving, Mike, and I don't mean it that way, but we're used to it. We install the plans, we run them for small businesses. As we said, they don't have the headache factor that they want to deal with. So they say, "Oh, you guys do it," and we do
Right.
it all the time for our clients. But you're all right, Mike. We come across it all the time. We're like, "Hey, you could be doing this. This is the benefits of doing it," and they just don't need another headache, right? So in an environment where they're dealing with employment issues, hiring and firing, they're dealing with regulations, they're dealing with tariffs. I was one company that imports a small amount of stuff. That tariff headache is absolutely mind-boggling, as every country is different, every piece of material is different. They have to comply. Now, New York State put another one on their plate, right? So again, we'll help them. That's our job. We'll figure it out. But it's not really, I think, in general, what businesses want to hear right now.
Right. And New York State, did install their own plan. I kind of to kind of make it, I guess, the path of least resistance. We looked at it. It's not particularly robust. It's not particularly, comprehensive. So, don't be that business owner who waits for the very last second and then winds up choosing, maybe the poorest plan on the block because it's the easiest plan for you to do. So do your homework, talk to a financial advisor, talk to us, talk to your accountant, but don't ignore it
Oh,
because the
don't
penalties could
ignore
be
it.
severe.
Yeah, and we have both of us have quite a large resource of CPAs and CPA firms. So again, our job is to help them help the client, right? But yeah, don't ignore it. Another reason for a business to leave New York, but don't ignore it.
So look, and I always like when it's just me and you on the show to give us a few minutes to talk about the models, right? Because we don't like to do that when we have guests. We don't think it's fair. We're just me and you. There's no judging. What's going on with the models? What have we been doing this year? I know you like small cap. I know we're building the international sector. So what have you been cooking up back there?
Yeah, so the biggest themes that have been working this year, and we mentioned international, right? So there was a thesis behind that, and we expressed it, and so far the thesis has been working. But the one area that we've been talking about for a long time, and hoping that the thesis would work, and it finally started in the fourth quarter of last year. And that's if the economic environment is relatively healthy. And I keep reminding people that, A year ago this time, people were talking the word recession. Nobody's talking recession anymore, right? So if the economy is relatively healthy and growing, if interest rates are low, then small businesses can do very well. Small businesses do not do well in a recession. They don't have a gazillion dollars of reserve. Medium-sized businesses borrow a lot of money. They don't do well when interest rates are high. So a low interest rate environment, a good growth environment is very healthy for small caps and mid cap stocks. We have a very healthy exposure, small caps, mid caps, international, and we're going to talk about dividend paying stocks in a second. And my God, they are just ripping today. Year to date, small and mid caps are up somewhere between 7 and 9%.
Hmm.
Mentioned international, that's up 7 to 10%. And high quality dividend paying stocks, all that boring stuff that nobody wants, Mike, right? Nobody wants that. I'll use the Vanguard Index as an example, up all in the value dividend space, again, up over 7% year to date. So we have a healthy exposure every one of those sectors, and the performance numbers for the year look pretty impressive. I always take that with a grain of salt because, it can change on a dime, but the theme follows the economic cycle, and right now the two are lining up. It's a very positive environment for these kind of stocks. And by the way, like international, small and mid cap stocks way, way underperformed for such a long time, right, Mike? You know this. You've been to the seminars and meetings just like me, and they go, oh, it's time to buy this sector, and nothing, right, Mike? Nothing for a very long time.
Right.
Finally, these sectors are really performing very, very well.
They absolutely are. And again, another thing we talk about all the time is the market's spreading out, the opportunities are spreading out. And again, we'll end where we started, right? All this money is being spent on AI, right? But that just means that if it's Amazon or Oracle or OpenAI or Apple, pick a company, they are now buying things from these smaller companies, right? So, as you said, there's going to be $1 trillion spent. It's going to be spent somewhere, and that's where this money is going.
Yeah, Mike, again, one of the major analysts in our industry, we're talking about, think about a data center. All right, there's going to be computer chips, but there's going to be a bunch of copper wires and fiber optic wires, but you need construction workers to build that thing, right? Uh, Once that thing is built, you're going to have 1,000 employees, making it up, right? You're going to have 1,000 employees, and they're going to have to go to lunch somewhere, and they're going to have to go shopping somewhere, and they're going to want to buy homes. So the economic impact of all this spills over into the rest of the economy. And a lot of small to medium-sized companies will profit from that economic activity. So there is a positive to AI to the smaller non-big tech stocks, right? But also we're now in I call it the weather report, where it's a very healthy weather environment for medium and small size companies.
All right, so it's going to be right there. We all going to put a bow on it. We're going to stop, and I know you're feeling a little under the weather, so I hope you feel good because we're going to be back next week with a new edition of the Labor Thought Report, Tom.
Yeah, I'm sure hopefully my head cold will be gone. Thank you, New York. And I'm looking forward to next week when I can be a little bit more normal. So thanks, Mike.
Have a good night, everybody.
Night all.